Hello, I'm going to be looking at balance sheets in this presentation. So we're covering the things that I didn't cover in the last presentation because the last one was about profit and loss. So we need to know, where is it, from here, all these terms and what these things mean. And we're going to be looking at liquidity, something called liquidity ratios. So they're current ratios and acid test ratios we're going to be working out. And these are our three financial accounts. Remember, we did cash flow in Unit 1. I've just done a video on profit and loss, the one prior to this one. And in this presentation, we're looking at balance sheets. Now, this is my first tip for students. They often get mixed up between profit and loss and balance sheets. Balance sheets show the value of the business. It's a way of valuing the business because it's going to show what the business own. It's going to show what they owe to suppliers, to banks, lenders, things like that. And it's going to show what's been invested into the business. So it doesn't actually show profit, a balance sheet. So just be very, very careful. If you do have a balance sheet question in your exam, make sure that you're not talking about profit if you're answering the balance sheet questions that go with it, because it's the profit and loss that you have to look at to find out how much profit they're making. Okay, so here's what a full balance sheet looks like, but usually in past paper exams or prior exams that have happened before now, they just show a little bit of the balance sheet, because actually what they're going to do, if they're going to ask you a question about balance sheets, they're going to be asking you to work out liquidity ratios, which only requires you to look at the current assets and the current liabilities. But let's just establish what a balance sheet is and the different parts. So it always starts off at the top with the assets, and this is what the business owns. Okay, and it can be split into two different sections. The fixed assets, and these are things that the business own that are going to last longer than a year. So property, equipment. Now, I always have a student, whenever I'm teaching this section, that asks me, what if the vehicle breaks down and it's unsalvageable, and you know, it doesn't work after, you know, it doesn't work, and therefore it's not lasted a year. It doesn't matter if that item does actually kind of break within that year. This is just a way of categorizing them into groups. Okay, the other type of asset is a current asset, and these are things that are going to be used up within the year. So we're hoping that that stock there that they've got of finished items, or maybe partly finished items, is going to be sold within the year. We've got cash that's going to be used up, we hope, and invested maybe, or distributed as profit. And then we've got debtors as well. Now, debtors, I'll do a definition of this afterwards for you, but debtors are just customers that haven't paid yet, so they owe the business money. Below the assets come the liabilities, and this is what the business owes. So we've got, we split these up, and we've got current liabilities, and these are responsibilities, these are debts that have to be paid within the year. So we've got creditors. Creditors are suppliers that you owe money to, and an overdraft. This is a short-term debt, remember, from sources of finance. And then we have, rather than calling them fixed liabilities, we call them long-term liabilities, or actually in modern accounting language, we call them creditors falling due after 1 year. But that's a bit of a mouthful, really, so I stick to the term long-term liabilities. And these will still be outstanding in a year. Now, you may have reduced that amount a little bit, but you're still going to be owing it after a year. The last thing that's at the bottom of a balance sheet is the capital and reserves, and this is what's been invested into the business. So we have, my balance sheet's a little bit cut off here. We have the shares issued. So this is share capital that's been invested into the business, and below here it does say retained profit. So that's been invested back into the business. That's net profit from previous year that's been reinvested into the business, sometimes called reserves as well. Okay, there's two other definitions as well that I said I'd define. These are debtors, so customers that owe money to the business, and creditors, these are suppliers that the business owes money to. They're usually suppliers. So you've got trade credit from them. So you've taken the supplies, but you've got 60 days to pay or something like that. Okay, so what we're looking at, if you see balance sheet in your test paper when you're in the exam, what they're going to ask you to do is to work out some liquidity ratios. Now, liquidity ratios are looking at how easily the business can pay any short-term debts. So what we're really interested in seeing is, where's my pen tool? It's not coming up. Here we go. What we're really interested in seeing is, luckily for you actually, because it makes it a lot easier, we're just going to be looking at our current assets and we're just going to be looking at our current liabilities. So you can kind of forget the rest. Now you should have an awareness as a business studies student. You should have an awareness of the whole balance sheet, but these two items are the really important things. So the first ratio that you need to know about is the current ratio, and this is the amount that the business has available to pay short-term debts, or it's going to show us the amount available to pay short-term debts. And the equation is current assets divided by current liabilities. Now you don't need to memorize that, because they will give you that in the exam, but just be a bit cautious. They might want you to add up these things here, so they might be able to work out your current assets, or they could ask you to add these up and work out the current liabilities. I think it'd be quite a complicated question, that one, but they could, theoretically. Okay, so if we add them up, we've got 70 divided by 55. There is our current liabilities, and that comes out as 1.27. So that means for every £1 of short-term debt that this business owes, they have £1.27 to pay it with. So that's not bad, really. They can, they can more than enough pay off all of the debt that this business owes. So usually we use that kind of 1 as a benchmark. So as long as they can pay it off, we'd say that that's quite good. Now, if you go on to do business studies at A-level, or you go on to do accounting, they'll give you some more direction on how to judge these things. But at GCSE, the general rule is if it's above 1, if the answer comes out as above 1, it's all right. They're doing okay. Okay, the other ratio that we look at is called the acid test, or sometimes called the quick ratio. And this is the amount the business has available to pay short-term debts with its available money. So what we're going to do for this one is we're going to take stock out of the question. I'm going to change my pen colour now so that we're working with a different colour for this one. So we're going to take stock out of the question. So we're going to do our current assets minus stock. And the reason for this is because if you had to sell your stock to be able to get the money to then pay the short-term debts, that's going to take a while. So this is called the acid test ratio, or the quick ratio sometimes, because it's saying if you had to pay off these debts like really quickly, as in the next few days, how much of them could you pay off? Okay, so it's going to be 25 divided by 55, which comes out as 0.45. So this means for every £1 of short-term debt they owe, they only have 45p to be able to pay it with. Okay, so this is not looking so great. Now, typically what you'd get in a exam question is you'd have 2 years to compare, and they wouldn't ask you to work out the current ratio and the acid test ratio. They're going to ask you to work out one of them. They're probably going to give you the previous year's current ratio or acid test ratio, so that you have to compare them. But they will ask you probably a 3-mark question after this balance sheet equation working out, and they want you to interpret it. Okay, so firstly, just as we did with gross profit margin and net profit margin, tell the examiner whether it has got better or worse. And remember, to pay all the short-term debts, the ratio has to be 1 or above. So if it's gone from 1.7 1 year and it's decreased to 0.9, that has got worse. If the number is decreasing in size, generally speaking, it has got worse. Okay, it does get a little bit more complicated than that when you get to A-level, but don't worry about that at this point. Okay, and then it depends on the question, really. Reasons why it might get worse. Well, there's only really 2 reasons why things get worse. So either your current assets have decreased for some reason. Maybe the business have been expanding really, really quickly, and they've been using some of that cash that they had and they've been investing it into long-term projects, such as buying fixed assets. That could be a reason why it could have got worse. So they just generally don't have as much cash available, or current liabilities have increased. So they haven't been, they've got higher overdrafts, maybe because of expansion as well. Maybe they owe their suppliers a lot of money. So those are reasons it could have got worse. The most likely question that you're going to get as a kind of 3-marker to follow up the calculation would be the consequences for the business. So when we're looking at a ratio that is below 1, so it starts with 0 point something, this is a little bit worrying because, and to be honest, it doesn't matter really at GCSE level whether you're looking at the current ratio or the acid test ratio. Whichever one they choose and they want you to work out, just go with that one. I mean, the acid test ratio is the one that's like, if you had to pay off everything this week, would you be able to? So it's a more kind of strict ratio to work out. If it was 0.9 as an acid test ratio, but it was 1.1 as your current ratio, we won't worry too much about that because it's almost a pound. But if it's, as I worked out before, 0.45, that is quite worrying. So consequences of that might be that banks are less willing to lend because they think, oh my goodness, is this business going to go out of business? Because usually businesses don't go out of business because they're not profitable. Most businesses can be profitable, but usually businesses go out of business because they can't pay their bills, and that's all to do with liquidity, being able to pay your bills. That's what liquidity means. So this is the one that you can use to see if this business is going to go out of business. So it'd be really interesting, I'm talking about this in 2016, it'd be really interesting to work out the current ratio of BHS, because obviously that's a bit of a business that is on the edge of going out of business, or it might be bought, or we don't know what's happening. And in the news yesterday, actually, Austin Reed went out of business. So it'd be really interesting to see what their current ratio and their acid test ratio is. That's something you could look up if you wanted to. Another consequence might be that suppliers are less willing to give trade credit. So they want to be paid immediately because they're thinking, this business might go out of business. I'm going to give them these goods and services. I might never get paid for them, so I'm going to make sure they pay when they get them. So that can cause, serious cash flow problems for the business if suppliers are less willing to give trade credit and banks are less willing to lend. That could really cause very serious cash flow problems, and that links into your Unit 1 there. Okay, so that is all of finance done, and the really good thing about finishing this section is if you haven't liked finance as part of your GCSE course, that's it. You are done when you get to the end of the balance sheet section. So that's all of finance that you need to learn for your GCSEs.